crypto arbitrage sounds like one of the cleanest money machines in finance. Buy a coin in one place. Sell it somewhere else for a little more. Repeat it enough times and the small gaps turn into real money. That is the story people want to believe. And to be fair, the idea is not fake. Price gaps do happen. Liquidity is fragmented. Different exchanges, different pools, different routes, different fees, and different users can create short windows where one path prices an asset differently than another. But here is the part most people do not learn until they actually build the scanner. Finding a price difference is easy. Finding a tradable edge after fees, slippage, routing, latency, and competition is the hard part. That is why so many crypto arbitrage bots look amazing in a spreadsheet and terrible in reality. In this video, we are going to break down what really kills crypto arbitrage profits, why a bot can scan thousands of routes and still reject every trade, and what a serious paper trading system should check before it ever touches real money. First, start with the spread. A spread is just the visible difference between two prices. If one route appears to turn $1,000 into $1,003, that looks like a $3 opportunity. But that is not profit yet. That is only the raw quote before the real market takes its cut. On decentralized exchanges, every swap has a fee. Then the next swap has another fee. If the route has 3 legs, that can mean 3 separate fee hits before the trade even reaches the finish line. Then there is slippage. Slippage is what happens when your own order moves the price against you. A tiny test quote might look profitable because it barely touches the pool. But a real trade size has to consume liquidity. The moment it does, the output changes. This is why trade size matters so much. A $500 route might look clean. A $5,000 route might turn negative. A $50,000 route might be impossible without moving the pool so much that the opportunity disappears. The bot cannot just ask, is there a spread? It has to ask, is there still a spread at the size we can actually trade? Next comes gas. On BNB chain, gas is usually cheaper than Ethereum mainnet, but it is not zero. If the expected edge is only a few dollars, gas can flip the trade from profitable to pointless. And if the route needs multiple calls, approval management, wrapping, unwrapping, or a more complex execution path, the cost and failure risk both go up. Then there is latency. An arbitrage opportunity is not a parking space. It does not wait for you. By the time a scanner sees the quote, calculates the route, checks profitability, submits a transaction, and gets included in a block, the market may have changed. Another bot may have taken it. A whale may have moved the pool. The quote you saw may no longer exist. This is where paper winners can be misleading. A paper trading system might say, this route was profitable at the moment of the quote. But a live execution system has to answer a harsher question, could we have actually captured that profit before the market moved? That is why replay testing matters. If a scanner finds a winner once, you should not immediately trust it. You should replay the same route, requote the trade, test the exact size, include estimated gas, and confirm that the edge persists long enough to matter. If the replay turns negative, that is not a failure. That is the system protecting you. A good arbitrage bot rejects bad trades far more often than it accepts good ones. Most of the work is not taking action. Most of the work is saying no. There are 4 big reasons a crypto arbitrage scanner should reject a route. Number 1, the edge is too small. If the expected profit is less than the combined cost of fees, gas, slippage buffer, and error margin, the trade is not worth taking. A bot that accepts tiny edges is not being aggressive. It is being sloppy. Number 2, the liquidity is too thin. Thin pools can produce exciting quotes for tiny amounts, but they are dangerous at real size. The bot needs to know whether the route can support the intended trade without destroying the edge. Number 3, the route is too fragile. More hops can create more theoretical opportunities, but every extra hop adds fee drag, execution complexity, and failure surface. A 3-hop path has to beat a lot more friction than a simple 2-hop route. Number 4. The token risk is too high. Not every token should be treated as clean collateral. Some tokens have transfer taxes. Some have weird decimals. Some can be paused. Some have blacklist behavior. Some have shallow liquidity and ugly exits. A quote can look profitable while the asset itself is not something you want your system touching. For a serious bot, token selection is risk management. Stablecoins and large liquid assets are boring, but boring is useful. The goal is not to chase the wildest quote. The goal is to find repeatable edges with controlled execution risk. This is also why bridge tokens and exotic Reuters need extra caution. If a route depends on a token that is really meant for bridging, or on a protocol integration that is not fully verified, the right move is usually to mark it as research only until the contracts, Reuters, and execution path are confirmed. Arbitrage is not just math. It is infrastructure. The scanner needs reliable RPC access. It needs accurate quotes. It needs token lists that are curated, not random. It needs duplicate route handling. It needs stale quote protection. It needs logging. It needs a paper ledger. It needs replay validation. And if it ever graduates toward live trading, it needs strict controls around private keys and transaction signing. That last part matters. A bot should not jump from read-only scanning to live trading just because one test looked good. The safe path is staged. Stage 1, read-only market scanning. The bot watches routes, records quotes, estimates net edge, and does not execute anything. Stage 2, paper trading. The system simulates fills, tracks rejected routes, tracks accepted routes, measures whether paper winners persist, and compares expected profit against replay results. Stage 3, dry run execution logic. The code prepares transactions but does not sign or broadcast them. This catches routing, call data, and gas estimation problems without risking funds. Stage 4, tiny controlled live tests. Only after the first 3 stages are boring, stable, and well logged should real money even enter the conversation. And even then, limits matter: max trade size, max daily loss, allowed tokens, allowed Reuters, emergency stop, and human review. The boring controls are what keep the bot from becoming an expensive lesson. So what should you look for if you are building or evaluating a crypto arbitrage bot? First, look at rejected trades, not just wins. A system that only shows profitable screenshots is hiding the most important data. You want to see how often it scans, how often it rejects, why it rejects, and whether the best near misses are getting closer or worse over time. Second, measure net basis points, not raw dollars. Basis points make routes comparable across trade sizes. A $10 profit on a huge trade might be terrible. A $2 profit on a small trade might be excellent if it is repeatable and safe. Net edge after costs is the metric that matters. Third, separate discovery from execution. Discovery asks, does a possible opportunity exist? Execution asks, can we safely capture it? Those are different problems. A lot of bots fail because they confuse the two. Fourth, assume competition. If an opportunity is obvious, other bots are already looking at it. That does not mean the market is impossible. It means your advantage has to come from better filtering, better infrastructure, better routing, better risk controls, or a niche that others are not scanning well. Fifth, do not romanticize autonomy. A bot that can lose money automatically is not advanced. It is just dangerous. The goal is not full autonomy on day one. The goal is controlled autonomy after evidence. The uncomfortable truth is that a clean no-trade result can be good news. If the bot scans a set of routes and finds no profitable candidates, that can feel disappointing. But if the system correctly filtered out negative edges, thin liquidity, and non-persistent paper winners, it did its job. A bad bot forces trades to feel productive. A good bot waits. In crypto, the market does not pay you for activity. It pays you for being right after every cost is counted. That is the real lesson behind arbitrage automation. The opportunity is not just in finding price gaps. The opportunity is in building a system disciplined enough to ignore almost all of them. Because the difference between a profitable trading bot and a money-burning machine is not the word arbitrage. It is validation. Scan carefully. Paper trade honestly. Replay the winners. Reject aggressively. And do not let a spreadsheet profit convince you to skip the parts of the system that keep you alive. Educational only. Not financial advice. Crypto trading is risky, and automation can lose money faster than a human can react. Build the guardrails before you build the trigger.